The yield curve takes a longer-term bond yields, like the one you get on a 10-year treasury bond, and shorter-term bond yields, like the one you get on a 2-year treasury bond, and it looks at the difference between them. This is what it looks like. This is the yield on a 10-year note minus the one on a 2-year note. Now, most of the time, you have the 10-year yield that is higher than the 2-year yield, so the yield curve is above zero. But sometimes the 10-year yield becomes lower than the 2-year yield, and that's what you call a yield curve inversion. Now, this usually happens because the Federal Reserve has been raising its interest rate. They control shorter-term yield, and so they can deliberately make it so that the yield curve inverts. This is what they call restrictive policy, something you may have heard them say before. Now, for reasons I won't get into in this video, restrictive policy isn't great for the economy. It makes banks in the United States stop lending, and every single time that leads to a recession.